All right, good afternoon. I think it's time that we perhaps had a discussion about the bond market. Um, Lots going on out there, lots of warning signs. We better have a look here, people. Uh, there are moments in economic history when the warning signs they arrive quietly, almost politely, before they begin to scream. And in 2026, the bond market is beginning to scream. For years, much of the public conversation focused on the stock market. The Dow rises, the Nasdaq falls, artificial intelligence surges, technology leads. Political commentators celebrate rallies as proof of national strength. But professionals, serious institutional investors, central bankers, pension managers, sovereign wealth funds, they watch something else. They watch the treasury market, not the stock market, the treasury market. Because the bond market does not trade on enthusiasm, it trades on trust. And what we are witnessing this year is a profound test of trust in the fiscal and monetary foundation of the United States. The numbers are sobering. The U.S. 10-year Treasury yield has climbed about 4.5%, while the 30-year Treasury recently crossed the psychologically critical 5% threshold. Levels not seen consistently since before the great financial crisis. That matters enormously. Every mortgage in America is tied to those yields. Every corporate borrowing decision, every commercial real estate financing, every federal interest payment, every pension liability calculation. When long-term treasury yields rise this sharply, the cost of the financial system rises with them. And this time, the danger is particularly unsettling because the bond market is flashing multiple warnings simultaneously. Inflation concerns remain persistent. Federal deficits continue expanding. Geopolitical instability in the Middle East has driven oil volatility higher. And global investors are beginning to ask a question that would have been almost unthinkable 20 years ago. And you know what that is. How much U.S. debt is too much U.S. debt? That is the question now hovering over the Treasury market. What makes this especially chilling is that many of the mechanics now emerging resemble the early stress fractures that preceded the Great Recession of 07-08. Back then, most Americans saw only surface prosperity. Housing prices appeared stable, equities were relatively resilient, consumer spending continued, but underneath, the bond market was deteriorating. Credit spreads widened, mortgage-backed securities became unstable, liquidity began evaporating in corners of the system few people understood, and eventually, confidence itself became impaired. Today, we are not replaying the exact same crisis. The banking system is better capitalized, household leverage is lower than it was in '07. Major corporate balance sheets remain relatively strong, but there is a different structural vulnerability emerging now. In '08, the fear centered on private debt. In '26, the fear increasingly centers on sovereign debt. The distinction is critical. The United States government is now financing deficits at interest rates dramatically higher than policymakers became accustomed to during the post-08 era of near zero rates and quantitative easing. America became accustomed to cheap money. Washington built fiscal assumptions around cheap money. Wall Street built valuation models around cheap money. But history teaches us that once bond investors begin demanding higher compensation for inflationary risk or inflation risk and fiscal uncertainty, the adjustment can become self-reinforcing. Higher yields increase government interest costs. Higher interest costs worsen deficits. Worsening deficits require more treasury issuance. More issuance pressures yields even higher. That cycle can become extraordinarily dangerous. We are already seeing tremors. Mortgage hedging activity has intensified. Treasury selling pressure this year, amplifying volatility across the yield curve. You hear that again? Mortgage hedging activity has intensified Treasury selling pressure this year, amplifying volatility across the yield curve. Analysts now warn that this convexity-driven volatility exceeds levels seen during parts of 2023. Meanwhile, the yield curve itself has shifted dramatically. For years, inversion signaled recession fears. Now the curve is steepening again, but for troubling reasons. Long-term yields are rising not because investors expect prosperity, but because they increasingly demand compensation for inflation, deficits, and uncertainty. And perhaps most unsettling of all this, the bond market no longer appears fully convinced that inflation will return cleanly to the old world of low rates and low volatility. That changes everything. Because once inflation psychology changes, markets change, politics changes, consumer behavior changes, corporate planning changes, and central banks lose room to maneuver. This is why experienced financial professionals watch the Treasury market with such intensity. Stocks can celebrate optimism, bonds price consequences. And in 2026, the bond market is telling us that the age of easy assumptions may be ending. The lesson of the Great Recession was not merely that leverage is dangerous, it was that confidence can disappear far faster than governments or markets expect. History rarely repeats itself exactly, but financial history often rhymes with extraordinary precision. Financial history often rhymes with extraordinary precision. And right now, the rhyme coming from the Treasury market is becoming impossible to ignore. I hope this provides some insight to this topic. It's going to be very, 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 very interesting couple months ahead of us, people. Lots going on out there. Let's keep our eyes on things. See how things go. Let's see what happens with this new gentleman, Mr. Warsh. I don't know what to say about him. I saw him getting sworn in today, and I got to admit, he struck me as a very relatively decent guy. Could be wrong. Don't know. We'll have to watch, wait and see how things go. Okay, but you know what's going on out there with the prices, inflation, the war in Iran. There's a lot of factors out there. And needless to say, you see the prices at the pumps everywhere you look, okay? So let's fasten our seatbelts and keep things straight and steady until we figure out what's going on out there, okay? Okay, have a pleasant afternoon.